Gen Irrigation come out with a very strong March quarter with both its top line and bottom line growing by as much as 26%. What have been the key factors contributing to the healthy quarter this time around? What is the road ahead for the company? Let's ask the management. Joining us on the show right now is Vice Chairman and Managing Director Anil Jain. Mr. Jain, good morning and thank you for joining us. What trends are you witnessing now with respect to business? And can you tell us a little more about what has aided this quarter and if we can expect the strength to continue as we move into the next couple of quarters as well?
Yes, good morning to all of you. Overall, as you see, we had a very strong growth in two of our major business segments. One is micro irrigation and second piping and project solutions. Now in both we have seen, whether the government, state government or individual entities are doing a lot of good infrastructure spend with a basic concept linked to the water and food security. So one is to provide, water to the farms and so on. Another is also to provide, drinking water in the cities to make them smarter, to make them better cities in terms of living standards. So in both of these segments, we are seeing we already have a very good order book. So this kind of growth we also anticipate in the next year on a higher base as well. So for this year, let's say we have grown about 17.6% global annual growth, which we have achieved. I would expect, the next year we also again, achieve between 15 to 18% growth on higher base. That's one point. But also this is India and it's an infrastructure spend, it's a government spend, it's about also consumption story. In terms of overseas, we did an acquisition last year in a distribution space in California, which is also doing well, and that would add more this year. In February, we did acquisition in a food processing company in Holland that would also add this year. So all in all, we expect very good top line growth. And in terms of margins, our margins in this quarter have been, phenomenally good. Even the raw material prices are going up because of the oil and the polymer is a derivative of the oil, which is our raw material, the polymers. We think we have enough pass-through mechanism to manage and maintain our margin despite this high level of growth. So all in all, momentum is very strong across all the sectors in the different businesses we are in.
Hi, Mr. Jain. Good morning to you. In fact, I was coming to that question on higher raw material prices that one has witnessed in the fourth quarter, because of which there was a mild bit of dip that one saw in your margins of almost 20 bips for the fourth quarter. Is that the only way to combat? Are you going to look to pass on the price increase? Will that impact your top line, or is any other strategy in place? And also tell us, do you expect the raw material prices to stay at the same level where they are currently even in FY19?
So prices might go up a little bit, but mostly in India, where we use these polymers, polyethylene especially, there are new capacities have come up from Reliance or ONGC, and IOCL and GAIL is also doing debottlenecking. So overall, there is ample supply, which kind of negates this cost pressure in terms of prices of the polymers which we buy. In terms of our ability to translate this back to our customers, we have good amount of project orders in hand, and there is an escalation clause in these projects. So combination of having a good amount of supply in this region, India and Middle East, and escalation clause in our customer contracts is how I think we can tide over this oil moving from 60 to 80 and the derivative impact. That's one. But some of our other businesses, like food processing, etc., the impact of this oil into rupee, in fact, will translate into benefit for us, because we do a lot of exports and there is no import content on fruit pulp or vegetables, etc. So there, hopefully, we will gain because of some of these external factors.
So Jain, just wanted to address your debt situation right now. The reason is that we have seen your finance costs increase to a certain extent. Just want to understand whether or not you are comfortable with your debt position. What is it right now, and if we can expect changes in this financial year?
If we look at the debt position compared to December, the debt in March is down by about 470 crores. The reason you see interest high during this particular period of time, it's the interest and finance cost. So we open a lot of letter of credits, etc. So there are some banking costs. Also, rupee depreciation took place during this period. So it's combination of that. Overall, our debt is now sub 4,000 crores. So debt to equity is less than 1. Even debt to EBITDA is, a little bit less than 3.5. And we expect that by March 19, debt to EBITDA will also be less than 3. And if we also dissect the debt, right, where is the debt sitting and what it is doing? So we have about 1,500 crore debt in India, which is mostly linked to working capital, small amount of fixed debt. And outside we have a long-term bond about for 1,300 crores. That's also due only in 21. So we don't have any pressure as such. This year, in the current fiscal, about 300 crore rupees of debt is going to fall due, and I believe we would be able to repay that out of internal accruals. So all in all, I think if you see our last 3-year period and going over next 2 years, we are moving very positively for deleveraging and improving our return on capital as well as the asset by managing debt in a better way. And also in the current year, I expect some credit rating improvements come based on these good results, and that should allow us to reduce the interest cost. So going forward, this year I think our overall interest has come out close to 460, 470 crores for the whole year. And I would expect that in the current year, we would bring it down to less than 400 crores. So that should be positive.